Okay, the two differences here. Let's try and understand them. Property is just bricks and mortar, isn't it?
Well, yes, I guess simple property is about bricks and mortar, but there are two ways of investing in it. Either directly, you go and buy a property, as you've just said, physically own it and run it and manage the tenants. There's residential or commercial. On the commercial side, you have the option of listed property, as you've mentioned too. The nice thing about that is you don't manage it. You're a passive investor. You can buy shares in Growthpoint, Redefine, one of the top listed entities, and you've got a management team running it for you. That actually appeals to me quite a lot because I'm one that doesn't fancy managing tenants. So that's the nice way. So there's no, now I'm sure we'll get into the detail of what's best and what's not best to invest in. There is no actual answer to that. There are different investment vehicles for different personalities. If you don't like the direct management, there's the listed sector. But unfortunately, the limitation of that is there's no residential listed property in this country at this stage. It's all just about commercial.
Marc, what's your gut feel on this? Where do you stand?
Well, I mean, again, it's, as John says, it's really a personality thing. It's also obviously how much money you've got and also what affinity you've got to investment in property and obviously your risk profile. So that risk profile, needless to say, changes between person to person. John mentioned listed property. Of course, you've got the other option of fund of fund or unit trusts, which could be focusing on listed property or a mixed bag of assets in a portfolio. So, yeah, there's really a broad range. The real question, I guess, in South Africa is there a major difference between investing in a unit trust or in a listed fund, which effectively mimics the broader index, if you like, in a unit trust. So, yeah, those are the kind of things that people need to think about.
Are there unit trusts specific to property?
Correct.
Okay.
Yes.
So I'm trying to break it down here. So you can either go and buy the property-based unit trust, or you can go into commercial property through you mentioned Redefine and Growthpoint.
Mm-hmm.
Yes.
And those are the only two options available to you from a listed property side. Is that correct?
Yeah, in a nutshell.
That's pretty much it, yeah.
Then your other alternative is you either go out and you buy a residential or a commercial property.
Yeah, commercial, industrial, well, commercial split into a retail property, an industrial property, or industrial and warehouse, or office space.
And you can obviously do that in a whole basis or, in partnership or subsidiary or, whatever, shares and so forth.
Right. I think I've got the basics right here, but now we've got to start looking at these and seeing how they perform, how they have performed, how they may be looking to perform. Let's start with the unit trusts first. Marc, you're probably the better person to ask this one.
Yeah, look, unit trusts and the actual listed sector are pretty much on a par.
Okay.
It's just a question of that, in a unit trust, you're really splitting your selection of, let's say, top funds. And as I mentioned earlier, really the choice hasn't been that great, but I think that's about to change. There's going to be a couple of new listings, probably about 4 that are going to definitely offer greater scope, greater liquidity, which just means you're able to trade in and out of them better. Although, of course, in a unit trust, that's effectively done for you, so you don't have to make that choice. But what I'm saying is that the choice of funds is probably going to be growing with about 15 billion rand of new assets of direct property brought into the listed sector. So there's not much to talk about. I mean, last year the listed sector returned about 28–29%. So that gives you a feel for sort of the differences. Yeah. Obviously, the part that the increase on return on listed is really to do with its equity position, as well as you could say its relationship to bond yields, which have obviously firmed, and that played in listed properties' favour.
Okay. There's far too much information in one soundbite for me there. So you're looking at about 13.8% in your fund and about 29 overall, generally.
Well, equities were 29, the listed property,
Yeah.
but the direct property portion is in real terms, with your total return, your income growth and your capital growth, income return capital growth is 13.3%. So that's how direct commercial property performed. The year before it was 8.8%. So obviously that's a cycle thing. So we came out a bit of a trough, and we starting to come out of that. Yeah.
John, let's talk bricks and mortar. How's that side doing now?
You're talking about residential property. I think still worse than commercial property. Marc mentioned a total returns of 13% last year. Now, in residential, unfortunately, the data is lacking when it comes to rental and therefore income data, so that side we don't have. Capital growth last year averaged 6.6%. There was a bit of a mini recovery after the interest rate cuts of 2009. What the yield is on residential property, I believe on average it's probably still quite low, but we don't have decent estimates on that. But I suspect it's lower than that 13% total return that Marc was mentioning for commercial property. The residential property underwent an almighty boom a few years ago. I think it's a lot easier for developers or wannabe developers, whatever you people with development ambitions, to enter that side of the sector. It's easier to build houses than to build commercial property. So I think as a result there was more of an oversupply created during the boom years, and we're now suffering the consequences.
Okay, so to me it sounds, once again it comes back to the old thing that everyone's been saying, if you're going to get into this, you're in it for the long term. So can we scope back further? I mean, when did listed properties start appearing and unit trusts, property unit trusts start appearing on the exchange?
To the best of my knowledge, I think the first listed fund was probably the mid-70s in South Africa.
That far
so
back.
They've been around for many years.
Okay.
Almost as long as you. And
I've been around a lot longer than that.
I'm joking. And yeah, so obviously it's a vehicle that's been, that's grown throughout the world. The globalization of real estate as an asset base has obviously helped that process. So we're seeing that a lot of what we call real estate investment trusts, that's a sort of collective term that's used for listed property around the world. And South Africa is going the same route. We've got effectively property unit trusts, PUTs and PLSs. Don't ask me the real difference. There's tax, there's a few major minor differences, but in essence they are real estate investment trusts. There is some legislation that's coming through at the moment that will obviously guide their development so that it looks like the rest of the world, and probably you'll find that greater interest from global investors will also occur as a result of that.
But over the, let's go back to the bricks and mortar. Over, let's say, the last 20 years, how have we looked from a residential and from a commercial point of view?
How far back does the IPD data go? I think that's only back till about the 90s. But I suspect probably very similar. Both had very significant booms in the in the last decade or so. So from now, going back 20 years a bit, I wouldn't be able to quantify it into a,
Sorry, you're not that old.
I'm not, sorry, I'm not that old.
You weren't even working in the business 20 years ago.
I wasn't, but from the late 90s, capital growth on residential property has been somewhere over 300%. But that that was the boom included, so it was an extra special time. It's something that's probably not going to be repeated again. Over the long term, though, my guess is that it doesn't. If you take it back to the 60s, well, we've got data back to this around about the 60s. It always depends where your starting point is in that data. But I suspect over the long term, it possibly doesn't outperform inflation that much. But then again, I would say that I would suspect the same for equities and a lot of others. A lot of these things are very much an inflation hedge, and in terms of capital growth, and then you generate an income on top of that, which gives you your real return. But capital growth-wise, I doubt that these things would differ too much from long-term CPI inflation over 40 or 50 years.
Yeah, I tend to agree. I think over 15 years, our average annual return, that's total return, has been around about 16.5%. Give or take, so we slightly below the average. But as John said, I mean, over that period, sort of 2001 to 2007-8, we had phenomenal growth. The bulk of that was the capital portion. So valuations were going up on the anticipation of good income streams, etc., etc. So yeah, so capital growth was very high last year. It was 4.2%. John mentioned around 6% on residential. which is actually quite good, I think, but 4.2. It was 0 the year before, so we've seen some improvements already. And obviously capital growth, in a sense, in a nutshell, really reflects outlook, forward-looking valuations.
Okay, but as you say, we must be careful looking at the history behind both the listed and the property, fixed property markets, because there was they've been skewed a little bit by that very happy time that some people had.